Okay, so on this opportunity, we are going to explain about the material in the chapter 14. So before that, let us introduce ourselves. My name is Radhika Inan Andini, the last two digits of M114. So for the first topic, we're going to discuss about the nature of bonds and indicate the accounting for bonds issuance. First of all, what is bonds? So bond is a long-term debt instrument arising from a contract known as a bond indenture. It represents a formal promise by the issuing company to pay a designated sum of the money at maturity or face value, plus with periodic interest at the specific rate. So, what is the purpose of bonds? So, the purpose of bonds are primarily used to borrow large amount of capital for the long term when the sum required is too massive for a single lender to provide. By dividing the debt into the smaller denomination. Let's go to the next slide. We're going to discuss about the common types of bonds. First, we have secured versus unsecured. For secured bonds, it's backed by collateral. For example, it's like mortgage bonds secured by real estates. And then for the unsecured bonds or debentures, they have no collateral backing and just rely on the user credits. And then the next step is the term versus serial. For term bonds, they mature on a single designated date, and for the serial bonds, they mature in a staggered installment over time. Then the next step, we have callable. So in here, they give the issuer the right to buy back and retire the bonds before their official maturity date. And okay, for the next types, we have convertible. So convertible allow investors to exchange their bonds for other security. It's like ordinary share, so within a specific time frame. And the next type we have registered versus waiver. So registered bonds are used in the owner's name and require official transfer tracking. Meanwhile, waiver or coupons bonds, it belongs to whoever physically holds them and transfer them by mere delivery. Then for the last type, we have commodity-backed and deep discounts. So commodity-backed bonds are redeemable in measure of a commodity. For example, it's like a silver and oil. And then for the deep discounts or zero interest bonds is sold at a steep discount and pay no periodic interest, it providing the entire return at maturity. Okay, now let's go to the next slide. We're going to talk about pricing of bonds. So bonds do not always sell for their exact value. It depends on how the bond's interest rate compares to the market rate. When they issued at par or when the state rate equals with the market rate, the bonds sell for exactly its face value. And then when they issued at discounts or when the state rate less than the market rate, the bonds pay less than the market, so the company must sell it cheaper to attract buyers. And then when they issued at premium or when the state rate are greater than market rate, the bonds pay more than the market, so buyers are going to be willing to pay extra to get it. Okay, maybe the next material will be explained by my friends.
Next material is valuation and accounting for bonds payable. The issuance and marketing of bonds to the public does not happen overnight. It usually takes weeks or even months. The selling price of a bond issue is set by the supply and demand of buyers and sellers, relative risk, and market condition. At the state of the economy, the investment community values a bond at the present value of its expected future cash flow, which consists one, interest, and second, principal. The rate used to compute the present value of this cash flow is the interest rate that provides an acceptable return on an investment commensurate with issuer risk characteristic. The first method is bond issued at par. To illustrate the computation of the present value of a bond issue, assume that Santos issues 100,000 in bonds dated on January 1st, 2022, due in 5 years with 9% interest payable annually on January 1st. At the time of issue, the market rate for such bond is 9%. As we can see in the chart, the actual principal interest cash flow are discounted at a 9% rate for 5 periods. By paying 100,000 the par value at the date of issue, investor realize an effective rate or yield of 9% over the 5-year term of the bonds. So these are the following entries in the first year of the bonds. And the next one is bonds issued at discount or premium. The difference between the face value and the present value of the bonds determines the actual price that buyers pay for the bonds. This difference is either discount or premium. So if the bonds sells for less than face value, they sell at discount. If the bonds sell more than the face value, they sell at premium. To illustrate, assume now that Santos issues 100,000 in bonds, due in 5 years with 9% interest payable annually at year end. At the time of issue, the market rate such bonds is 11%, as in the chart. The actual principal and interest cash flow are discounted at an 11% rate for 5 periods, as calculated in the chart. So by paying 92,000 at the date of issue, investor realized an effective rate of yield of 11% over the 5-year term of the bonds. This bond would sell at discount of 7,392. The price at which the bond sell is typically stated as a percentage of the face of par value of the bonds. For example, the Santos bond sold for 92%. If Santos had received 1,002,000, then the bond sold for 102% of par. So the next one is effective interest method. When a company issues a long-term debt, like bonds, the interest rate written into the contract is called the stated coupon or nominal rate. However, the market or investment community often demands a higher rate of return based on risk, economic condition, which is called effective yield or market rate. So if investor demand a higher return than the stated rate, the bond sell for less than face value at a discount. If an investor accept a lower return than the stated rate, the bond sell for more than face value at a premium. So the first method is bond issued at discount. To illustrate amortization of a discount under the effective interest method, assume Evermaster AG issued 100,000 of 8% term bonds on January 1st, 2022. On January 1st, 2027, the interest payable each July 1st and January 1st because the investor require effective interest rate of 10%. They paid 92,278 for the 100,000 of bonds, creating a 7,722 discount. So this was the schedule of bond discount amortization with the effective interest method, semi-annual interest payment. Evermaster record the interest expense occurred at December 31, 2022 year end and amortization of the discount as follows in the ledger. Interest expense 4,645 in the debit side and interest payable 4,000 and bonds payable 645 at the credit side. The next method is bond issued at a premium. Now assume that for the bond issue described above, investors are willing to pay an effective interest rate of 6%. In that case, they would pay 108 and 533,000 or a premium of 8,530. So this was supposed to be the schedule of bond premium amortization, effective interest method, semi-annual interest payment, 5-year 8% bond sold to yield 6%. So Evermaster record the first interest payment on July 1st, 2022 and the amortization of premium as follow: interest expense. So bond issued between interest dates, companies usually make bond interest payment semi-annually on dates specified in bond indenture. When companies issued bond on other than interest payment dates, bond investor will pay the issuer the interest accrued from the last interest payment date to the date of issue. The bond investor in effect pay the bond issuer in advance for that portion of the full 6 months interest payment to which they are not entitled because they have no hold of the bonds for that period. Then on the next semi-annual interest payment date, the bond investor will receive at full 6-month interest payment. So to illustrate, assume that instead of issuing bond at January 1st, Evermaster issued at its 5-year bond dated January 1st, 2022 and on May 1, 2022 at par of £100,000. Evermaster record the insurance of the bond between interest date as in the chart. Because Evermaster issues the bond between interest dates, it records the bond issuance at par 100,000 plus accrued interest 2,667. That is the total amount paid by the bond investor includes 4 months of accrued interest. On July 1st, 2022, 2 months after the date of purchase, Evermaster paid the investor 6-month interest by making the following entry: the interest expense 5. On July 1st, the interest expense account now contains a debit balance of 1,333, which is 4,000 minus by 2,667, which represent the proper amount of interest expense 2 months at 8% on 100,000. Next method is bond issued or premium. To illustrate, assume that Evermaster 8% bond were issued on May 1st, 2022. To yield 6%, thus the bond are issued at a premium. In this case, the price is 108 and 39. Evermaster record the issuance of the bonds between interest dates as in the chart. In this case, Evermaster a total of 110,706 at issuance compromise of the bond price 108,039 plus the accrued interest of 2,667. Following the effective interest procedure, Evermaster can determine the interest expense from the date of sale, May 1st, 2022, not from the date of the bond, January 1st, 2022. So, like it's shown in the chart, the premium amortization of the bond is also for only 2 months. It's computed by taking the difference between the net cash paid related to the bond interest and the effective interest of 180. As indicated, the both bond interest expense and amortization reflect the shorter 2-month period between the issue date and the first interest payment. Evermaster therefore making the following entries on July 1st, 2022 to record the interest payment and the premium amortization. Like in the chart, the interest expense account now contains as debit balance of 1,080, which is 4,000 minus by 2,667 minus 253, which represent the proper amount of interest expense 2 months at effective annual interest rate of 6% on 108 and 039.
For the next part, we are going to talk about the long-term notes payable. What is long-term notes payable? It is a debt that the company must repay after more than 1 year, and they are commonly used to finance business operations, equipment purchases, or property acquisition. So for the classification of long-term notes payable, they are classified as notes issued and not issued at face value, the special notes payable situation, and the mortgage notes payable. So when the notes interest rate are equals to the market rate, and when the company receives cash equal to the notes face value, the notes payable are issued at face value. And if the note's interest rate is different from the market rate, or the note is recorded at its present value, or also the difference is recorded as a discount or premium and amortized over time, the notes payable are not issued at face value. And for the special notes payable situations, companies may issue notes instead of paying cash, and if the interest rate is missing or unrealistic, an inputted or an estimated market rate is used. And for the last part, that is mortgage notes payable, a long-term loan used to buy property, and the property serves as collateral, and the lenders may charge points, increasing the actual borrowing cost. So that's all from the long-term notes payable part. The next will be presented by my friend.
So, hello everyone, my name is Sagit Firmansyah with last 3 digit NPM 186. So now I'm gonna explain about the extinguishment of non-current liability. So, if a company holds the bond or any other form of debt security to maturity, the company does not compute any gain or losses. It will have fully amortized any premium or discount at the date the bond mature. So as the result, the carrying amount, the maturity face value, and the fair value of the bond are the same. So therefore, no gain or loss exists. So in this section, we discuss the extinguishment of debt under three common additional situations. The first one is the extinguishment with cash before maturity, extinguishment by transferring asset or securities, and the last one is extinguishment with modification of term. So we move into the next slide. Extinguishment with cash before maturity. So when extinguishing debt before its maturity date, the first required step is to update the amortization of any premium or discount up to the exact requisition date. Following this, the company must compare the requisition price, which include the total amount paid and equal premium and requisition expense, with the debt carrying amount defined as the maturity value adjusted for any amortized premium or discount. Based on this comparison, the company will recognize a gain and extinguishment if the net carrying amount exceeds the requisition price, whereas a loss is recognized if the requisition price is greater than the carrying amount. So to illustrate this, we use the Evermaster bond issued at a discount on January 1st, 2022. These bonds are due in 5 years. The bond have a par value of 100,000 euro, a coupon rate of 8% paid semi-annually, and were sold to yield 10%. So on January 1st, 2024, 2 years after the issue date, Evermaster calls the entire issue at 101 and cancel it as indicated in the amortization schedule. The carrying value of the bond on January 1st, 2024 is 994 and 925 euro. It indicates how Evermaster compute the loss on redemption extinguishment. After that, Evermaster record the requisition and cancellation of the bond with bonds payable at debit and loss and extinguishment of debt on debit and cash on credit. So Refunding is the practice of replacing an existing bond issue with a new one, typically to take advantage of lower interest costs. When a company retires its debt early, the accounting treatment is exactly the same whether it involves a refunding or a non-refunding situation. So the company must recognize any resulting gain or loss, the difference between the requisition price and the carrying amount in the income statement during the period the redemption occurred. Next is extinguishment by exchanging asset or securities. So the debt application can be settled without using cash by transferring non-cash assets such as real estate or receivable, or by issuing the debtor's own equity shares. In this non-cash transaction, the creditor is required to record the received asset or equity interest at their fair value. For the debtor, this transaction triggers two distinct accounting events. First, the debtor must recognize a gain on the extinguishment of debt, which equals the amount by which the debt's carrying amount exceeds the fair value of the transferred asset or equity. And second, if non-cash assets are transferred, the debtor must also recognize a separate gain or loss on the disposition of asset, calculated as the difference between the asset fair value and their carrying amount or book value. As we can see here, the transfer asset, we assume that Hamburg Bank loaned 20 million euro to bond mortgage company. Bond in turn invested these monies in residential apartment building. However, because of low occupancy rate, it cannot meet its loan obligation. So Hamburg Bank agrees to accept real estate with a fair value of 16 million euro from bond mortgage in full settlement of the 20 million euro loan application. The real estate has a carrying value of 21 euro million euro on the book of bond mortgage. So the bond debtor record this transaction with notes payable to Hamburg Bank in debit 20 million, loss on disposal of real estate 5 million on debit, real estate on credit 21 million, and gain on extinguishment of debt 4 million in credit. So, due to financial difficulties caused by low occupancy rates, bond mortgage cannot repay its 20 million euro loan to Hamburg Bank. To settle the debt in full, they agree to an agreement where bond transfer real estate to the bank. This property has a current fair value of 16 million euro, but is recorded on bonds book at a carrying value of 21 million euro. So to record this transaction, bond markets must recognize two separate financial impacts. First is loss on disposition. A loss of 5 million euro is recorded for the real estate, which is the difference between its higher book value 21 million euro and its lower value 16 million euro. Second is gain on settlement. A gain of 4 million euro is recorded for the debt extinguishment, representing the difference between the higher loan obligation, 20 million euro, and the lower value of the property used to settle it, 16 million euro. Next and the last one is the extinguishment with modification of term. So, when a borrower is experiencing financial difficulties, a creditor will sometimes grant favorable concession to maximize their chance of recovering the loan. Common modifications include extending the maturity date, lowering the stated interest rate, reducing the principal amount, or deferring accrued interest. First, the economic impact. Because the creditor is relaxing the term of the agreement, the debtor relies on economic benefit or gain. And second, the accounting process. So to record this, the debtor treats the old debt as if it has been fully paid off or extinguished, and records a brand new obligation based on their fair value of the newly modified term. And last one is recognizing the gain. So finally, the debtor recognizes a gain on extinguishment. This gain is calculated as the difference between the carrying value of the old original debt and the fair value of the new modified debt. So that's all from the material from me. The next material will be presented by my friend.
So I wanna explain about fair value option. The first option is fair value measurement. So it's usually long-term debt is written down using its original historical cost, adjusted for any discounts or premium. Under the fair value option, a company can choose to record its debt using current market prices instead. For example, if market interest rates go up, the market value of a company's fixed rate bond drops. Under this option, the company reduces the debt amount on its balance sheet and record an unrealized holding gain or loss income in credit. So for the second option is controversy. So a bond's market value often drops because the company is struggling financially and its credit rating gets worse. For the solution, to fix this, accounting rules say that any change in debt value caused by the company's own credit problems cannot be counted as regular net income. Instead, they must be listed under Other Comprehensive Income or OCI to keep the main profit numbers clean. Off-balance sheet financing. It is a method where a company borrows money or gets assets but structures the deal so the debt does not have to be listed on its official balance sheet. So it has different forms. The first is non-consolidated subsidiaries. A parent company owns less than 50% of other smaller company. The parent company doesn't have to combine the financial statement. And for the second is special purpose entities. A company creates an independent, separate legal entity to build a major project. The parent company guarantees to pay everything the factory makes. This allows to get bank loans without the debt appearing on the parent company's book. And for the rationale, it's better ratio. Leaving debt off the balance sheet makes a company look financially stronger and healthier than it actually is. And it helps the company avoid breaking strict limits on borrowing that were set by its current bank. And it's can cheaper borrowing. A clean balance sheet make it easier and cheaper for the company to get new loans in the future. So for the presentation, at the top left, you can see their main balance shows they owe 22,470 million in long-term debt. And the table directly below that opens up the bill to show us the detail. It shows what kind of debt it is and give a clear year-by-year timeline of when these payments are due. And for the right side, it gives us the important fine print, so it shows how much currencies the debt is. Now, in analysis of non-current liabilities, it has to analyze that. This for the first is debt to asset ratio, so this measures what percentage of the company's total assets were paid for by borrowing money. A higher percentage means a higher risk of going bankrupt. To know the ratio is use this formula. The formula is total liabilities divided by total asset. For the second, it's times interest earning or TIE. So this measures how many times over a company can pay its annual interest expense using its operating profits before taxes and interest are taken out. A higher number means a company has a safe cushion to pay its debt. For no, the times interest earned is use this formula. The formula is that income plus interest expense plus income tax expense. For the result of all of that, it's divided by interest expense.